defined, and let me just list them for you. These are technical terms which have a meaning within engineering finance. So the nominal rate, we have the per period rate, we have the effective rate, we have the reinvestment rate, and finally, we have the bond rate. So these are different manifestations of an interest rate depending on the situation. Today, I'd like to talk about these three, and then when we talk about bonds, we'll talk about the bonds. Let me just use an example here. Essentially, I've got a loan where the bank is saying 8% interest compounded quarterly, and I'm going to borrow the money for a year. So the bank would just tell me interest rate's 8%. That we refer to as the nominal rate. It's the annual interest rate. So they'll just say 8%, and then they'll specify some frequency of compounding. Okay. Compounded annually, compounded daily, whatever. Now, when I actually do an analysis, if I have cash flows, I want my period to line up with the cash flows, because interest normally is earned or paid from the time the money actually hits the account. So I'm going to have a per period rate. Well, in this example, if I've got an annual nominal rate of 8% and it's being calculated every 3 months or every quarter, then my per period rate, well, 8% divided by 4. So I'm going to have a per period rate of 2%, where the period, or periodicity, is a quarter, or 3 months. Okay. And typical numbers are semi-annually, every 6 months, monthly, or in the extreme, daily. Okay. Now, because I'm paying interest on interest, interest gets calculated every 3 months, added to the account, and then I not only owe the 1,000, but I owe the interest as well. The effective rate that I'm paying is going to be more. I just want to talk a little bit about that. Well, the first way to look at it is, perhaps, let me just use my F given P formula. Because what do I have? I've got a borrowing of 1,000, and I've got some future sum that I owe. And if I say interest is calculated every quarter, okay, well this time period is a year, but in terms, if I denominate it in terms of quarters, I've got 1, 2, 3, 4. And so one way of figuring out F is to say, well, isn't that a future value? But now rather than having an annual interest rate, I'm going to have a period that's 3 months and a 2-month rate. So F then will simply be 1,000, F given P, 2% times 4. In other words, 4 compounding periods. Okay. And as the numbers suggest, I not only owe $80, 8% of 1,000, but I owe another $240, which is really reflective of the fact that each quarter I owe more because the interest is added to my indebtedness. And so if I just to show you what's happening, and I always like showing you step by step. Well, in the first month, I owe in the first quarter, first 3 months, I owe $1,000. So 2%, $20. And so at the end of the quarter, $10.20. Now, with simple interest, the bank would say, okay, next month you still owe 1,000. But with compound, they say, no, you owe us the interest as well as the 1,000 you borrowed. And so for that quarter, you pay 2% of that additional amount. So it's another 40 cents because you're paying 2% of $20. I think you get the idea. Each month, your indebtedness goes up because they deem that you owe the interest that you didn't pay until the very end. And of course, I owe more than 10 years. So this really means then that I owe 8.24% of the money as interest. So while the bank is telling me my interest rate is 8%, in effect, I'm paying 8.24%. Okay. And so the effective rate on this transaction is 8.24%. Okay. And so it's interest on interest. And our general formulation for it, in terms of I effective, looks at the nominal rate R, frequency of compounding, so in this case, M is 4. Okay. And I then can just calculate the effective rate. So if I put the numbers in here, there's my 8.24%. So that's what you're really paying. No, of course not.
So what happens if you start like paying your interest quarterly, so then your interest rate goes up and down?
Then your indebtedness would not change, and so you'd be paying essentially $20 every quarter.
So that would mean the interest rate you're going to lose something that would be still 8%.
In that case, it would be 2% per quarter, and you're just paying it as you're going along. So like a line of credit, for example, you might just pay the interest. So you're renting $1,000 for the entire year, but you're paying that 20, on March 31st, on June 30th, September 30th. Okay, so you don't owe any more. So essentially, we're paying more. That's what we do in business and everything. Virtually everything is compounded interest. Our U of T example I alluded to the other day. Well, we tell students that we charge them 18%. But of course, we compound monthly. If I took that 1.5% and compound it 12 times throughout the year, we're really charging 19.6%. So the effect of that compounding is an extra percentage and a half. But of course, legally we can say, oh, we can only charge 18% compounded annually, and we wouldn't tell specifically what that effect would be. So this is essentially the way that we handle things in business. Okay, now, this is what we call discrete compounding. So in other words, there is a finite period where we calculate the interest, and in business, daily is usually the most frequent. There is theoretical infinite continuous compounding, so we're doing it every microsecond, every nanosecond, and that, of course, doesn't equal infinite interest rates. It does asymptotically close into particular numbers, and that's good for theoretical derivations. We don't use it in business, so I won't talk about it very much. But there are two tables in the back of the textbook. The first one is discrete, which is what we use for the course, and the second one is this continuous compounding, slightly different numbers, so steer away from that set of tables. Will mislead you in terms of the right numbers. A lot of students just bookmark their text for the various interest rate tables. So always use discrete compounding tables for a second. Okay. So let me just apply this now. And I want to talk a little bit about bank accounts, just to sort of give you a sense of how you might want to analyze what accounts best for you. Financial institutions have a variety of different bank accounts with different interest rates and different rules and regulations as to minimum deposits or how much it costs to take your money out or when they pay the interest or what have you. But it basically boils down to, well, what is my deposit and withdrawal pattern? Okay. And what account is best for me, given the various accounts out there for what I do. And I'd just like to show you a simple example where I've got a savings account where I'm assuming I put the money in and it stays there for a while. And normally those accounts pay a higher rate of interest. But they also generally have a large minimum balance and they charge you a lot of money, maybe $5 a transaction to take your money out, but they pay you more. The idea is they want that money to stay there because they're putting it away in longer investments. And then there's a daily interest account, which might just be your normal run-of-the-mill checking account. You get paid, end of the month, and then you make withdrawals throughout the next month, and hopefully there's some money left over by the next time the next paycheck comes along. But basically, it's a sawtooth pattern, and that would generally be a low interest rate. And I'd like to just look at the future value calculation for two accounts. One is a savings account where the stipulation is, yeah, we're going to pay you an interest rate, but it's going to be on the minimum value for the quarter. So they do a minimum of all the daily balances, and the minimum one they pay the interest rate on. And the daily interest is just from the time I put the money in, I'm starting to earn. And what I'd like to do is look at a frequency of deposit monthly and see what the future value of both accounts are. Now, normally the the savings account would pay a higher rate of interest, and the daily less. I just use the same interest rate, so I don't have to carry two different interest rates throughout this example. But by and large, a savings account would probably pay significantly higher, given this very, very punitive stipulation in terms of how they pay interest. But let's just use the same one for the time being. So what do I need to do? Well, the first problem is that the bank stipulates the interest rate to be 8% compounded quarterly. So 8% nominal rate per period, 2% if we're doing it quarterly. And we're really getting 8.24% if we leave our money in for the entire year. Okay. Now, if I've got cash flows coming in monthly, I'm going to want to value those on a monthly basis because I get paid from the second account on the basis of when the money comes in. So I want to line up the interest rate with the frequency of cash flow. So I'm going to define my period here to be a month, which then of course means that this number is useless because this is quarterly. So I want a monthly rate. Well, what do I want the monthly rate to be? Well, I want it to be the same as this. Because effectively I'm being paid this. So why don't I simply say, you know, I'm going to let I sub 12 equal my monthly rate. And don't I want it to be the same effective rate as the 8.24%? So given the specification 8% compounded quarterly, I can calculate this number, right? And that's 8.24%. And then let me find a number where I'm compounded 12 times for it to be the monthly rate. And so essentially I'm going to then say, well, I'm going to take 1 plus I right, where I can calculate I effective, which I have, 8.24%, and solve for I12. If I do that, I12, the monthly rate, is around 0.66%. So think about that number. If I compound it 12 times, I'm going to get 8.24%. So it's equivalent. And I can basically use it then to value my cash. So let me look then at the deposit pattern. So January 1st, you're going to put in $10,000, and first of all, put it in the minimum quarterly balance, the savings account. Okay. And then February, March, and then ask the question at the end of the quarter, March 31st or April 1st, what's in the account? Well, the computer on March 30th is going to look at every daily balance, and they're going to do a minimum. And on January 1st, the minimum balance for the 3 months was $10,000. 2% of that is $200. So the future value of the account, let's say on April 1st, is $30,200. In other words, for our deposit pattern here, this account's horrible because I'm putting money in February and March, and I'm not getting any interest on it. So this is probably not a good account for this type of deposit pattern. The other one, however, as soon as I put the money in, I'm going to earn interest. And here, the monthly interest really serves us well. Because now I've got this I-12, and I'm going to show you just a couple of ways of doing it. First way is, we wouldn't do it this way, but just to show you what's happening. Let's say I put $10,000 in January, and they're paying me from time of deposit 0.66% per month. Well, doesn't that mean that that amount gets compounded 3 times? Isn't this F given P 0.66% on the 3? The compound factor at 0.66%. And so that one deposit by itself will have a future value of $10,200. Okay. Now, the $200, is that just coincidence? Okay, is that number significant at all? Can I relate that to any of this? Think about it. Did I not calculate the monthly rate to be the same as this? And therefore, if it's the same as this, over a quarter, isn't it 2%? And so this $10,000 is in the account for 3 months, and the 3-month rate from over there is 2%. So we would expect $200 interest in this account if we kept the money in for a quarter. So that's this first number here. The next future value is less than the first one because the deposit's only in for 2 months. So this guy here, F given P, 0.66%, comma 2, and comma 1. Okay. So the future value of this account is significantly higher than the one over there. It's $30,399. Yeah. And so, of course, given the choice between the two, the savings account is, or sorry, the savings account is not desirable at all. I'm going to go with the daily interest account, okay, or from the time deposit account, the checking account. Okay. So this is what's happening. But if I wanted to do a valuation, I don't want to do all of that arithmetic. What I want to do is, again, use all these symbols that we've talked about to try to figure out, well, what's the future value of this? And again, I've got to understand how the formulas work through idiosyncrasy. And so let me just draw this out for you. So if I'm making these deposits, okay, and I've got January, February, March, and my question is, beginning of April, future value, question mark. Well, I've got an annuity, right, and I'm putting in $10,000 a month. My period is now monthly, and my per period rate is 0.66%. So the first thing I'm going to do is recognize an annuity there and say, well, what's the future value of that? Well, 10,000, F given A, 0.66%, comma 3. But now I need to recognize that that F given A values it not where I want it, here. So the formula just says right here. That's how much money is in the account